Anthony Fletcher here. Thanks for joining my video. I sure appreciate you coming. Today we're going to be talking something a little weird that we don't normally talk about. And we're going to talk about why anybody in this right world would only put 19% down on a conventional mortgage when they could put 20% and avoid mortgage insurance. Why would you want to do that? Why would anybody want to do that? And why would a lender advise you to put only 19% out and take mortgage insurance? Well, let's discuss what mortgage insurance is first. Now, weird thing is mortgage insurance is insurance that is taken out by the lender, which you pay for. And this default insurance, this isn't the same thing as fire insurance through, either Geico or State Farm or Farmers or any of those people. This is simply default insurance. And what default insurance is everybody that puts less than 20% down on a house with a conventional loan, they're required to pay for that. And the lender puts a chunk of money away each month from your payment into an account. And that account is blended with everybody else's accounts that's in the same situation as yours. And then if your loan goes bad, then what happens is the lender can go to that pool of money and pull the money out and pay off your mortgage. And so that's what that's for. Now, we're going to look at a scenario here in which actually paying for it is a little bit better of a scenario for you than if you were to just put 20% down. So let's look at this out. The scenario that we have here is a $600,000 house, and they're putting 20% down. This person has a 740 FICO score, so pretty good. And today's rate with this particular lender is 6.875, and their payment's going to be $3,153 a month. Okay, so this is for a $480,000 loan, and their total payment is going to be $655,172 by the time they pay everything off. Now, let's look at this other scenario here. Now, this one, it's a $600,000 loan. They're only putting 19% down on this loan, 740 FICO score. The rate, though, with the exact same lender and plugging in this scenario, the rate is 6.5. It's 3/8 of a point lesser in rate than by putting 20% down. And the payment, instead of being $3,153, it's now $3,033. Now, you do have to pay the mortgage insurance, but the mortgage insurance will be there between 1 and 2 years, depending on the lender that it actually goes with. So let's assume, and the calculation is $47 a month, which would have pulled out to be. So your total payment's $3,080. Okay? So your loan amount's $486. Your total payments on this one, $612,300 for the mortgage. And then your mortgage insurance payment, $1,128, for a total payment is $613,428 versus $655,172. So this one's your winner. It saves you over $41,000 through the process of the entire loan amortization. So, and you can see, because what happens here is we have the $3,153. And it's $3,080 for the first 2 years, and then this 47 will drop off, and it'll just be the $3,033 for the rest of the 28 years, saving you $120 a month. So there you go. So what the moral of the story here is, you want to make sure you talk to your lender, and if it's close and you're putting 20% down, talk to your lender and say, hey, maybe it's better I only put 19% down. Or maybe if the lender's putting, maybe it's, if you don't have 19%, maybe 15% down or something like that. You'll get the same rate and everything. So make sure you talk to your lender ahead of time and go over these scenarios with you, because it could save you a lot of money. And if the lender's not bringing that up to you, bring it up to them, because it's important that they know it too. Thanks again for watching today. I sure appreciate it. Hope you like my channel. Please subscribe. Take care. Bye now.